Alright, guys, so let's talk about the big British bond collapse. Now, we all saw this coming a mile away, and Trump's trade war is just accelerating the whole process. Now, when a country like the UK has a bond crash, it's a big signal, warning signal that investors have lost faith. The country is in an enormous debt problem, and the economy is cracking, and confidence is shattered. Like other Western economies, the UK is trapped between spending more money to survive or massive cutbacks to prevent an implosion of the national debt. Sounds very familiar, doesn't it? Now, despite the Bank of England cutting rates 5 times in the past 12 months, yields have shot to the moon. We are now at 5.7% for the first time since April 1998. That's a 27-year high that really highlights how disastrous the entire situation has gotten. Now, when yields go up, this inflicts a double whammy on the British government. Existing bondholders lose value, so they get very, very pissed off. Interest payments on sovereign debt starts to rise, especially when you need to roll over all your borrowing. Now, the UK's debt to GDP also stands at a terrifying 100%. So the entire economic output is equivalent to the country's national debt. But unlike the United States, the UK doesn't hold the reserve currency, which means there isn't an organic demand for pounds like the dollar. And in a worst case scenario, there's no way for them to print their way out of this mess. It will just lead to hyperinflation. It's so crazy that the UK might actually need a bailout from the IMF. Imagine that. Just a decade ago, this would be unthinkable. But investors are not optimistic in the slightest of the British economy. The UK today is now caught in a fiscal doom loop. The party today wants to increase taxes on the country to raise revenue. At the same time, there's no commitment of big spending cuts. So what we have is smaller private sector and bigger government. There's also big speculation of a £50 billion black hole in British finances, and normally the plan is to borrow a ton of money to finance the bill. However, Rachel Reeves has a ton of fiscal rules, so that option is out of the window as well. Even Thatcher's warning is applicable in this instance.
Let us never forget this fundamental truth. The state has no source of money other than the money people earn themselves. If the state wishes to spend more, it can do so only by borrowing your savings or by taxing you more. And it's no good thinking that someone else will pay. That someone else is you.
So the UK is forced into an impossible situation. They need to cut government spending and reduce taxes to show investors that the UK is still a viable destination for business. Basically, get more money into private hands. But the higher bond yields go, the worse it gets for the execution of the fiscal plan. The rule is to cover government spending with tax revenues, and that's why taxes are going up. However, this could crush private consumption and force the government to borrow even more money. It's basically one big doom loop. The UK is already spending 8% of their £1.3 trillion budget on just interest on the national debt. That's double the amount before the pandemic. That's £1 in interest for every £12 spent by the government. Now, the strain is enormous, and with yields heading towards 6% on a 30-year, this is not a good sign. Remember, they don't have the reserve currency status anymore. This isn't the British Empire. Those days are long gone. Interest on the national debt itself is nearly 4% of the country's GDP. And in 2024, the British economy grew by only 1.1%, so the interest payments alone is almost 4 times the amount of economic growth. And when you view things from this light, it's understandable why investors they are bailing out. They don't see a future in British bonds when the underlying economy is starting to collapse. Now, when you pile on Trump's trade war, the 10% baseline tariff on the UK, it just adds more strain to the camel's back. Exports from the UK to the United States are just getting hammered. So even more companies and firms have to close down, which will nuke tax revenues even more. Unfortunately, the story gets even worse. Now, when your bond market falls, chances are your currency will start to crash as well, because the underlying asset that underpins every bond in the world is the currency itself. Now, the pound sterling is set for its worst day since June. The pound crashed by more than 1% because investors are bracing for the worst. So, you have fewer bond buyers, demand for the currency is naturally down. On the other hand, you now have speculators thinking that the Bank of England might actually step in to intervene, basically buying more British gilts to take the pressure off the bond market, to take the pressure off bond yields. But therein lies the big problem. When you do that, it's basically QE, quantitative easing. You are just printing money. Now, traders in the options markets are betting against the sterling. Even as Trump tries to crush the dollar, the UK is destroying the pound at an even faster rate. And that's really saying something. And pray tell, what happens when your currency drops? Imports suddenly get more expensive, inflation goes up, and so does the cost of production for your industries. So the British economy is now facing a triple whammy. It's harder to manufacture export stuff, the cost of living will rise, and the national debt is one step closer towards implosion. Now, there's a reason why we titled the video that US Treasuries will be next. The entire G7 economies are already facing rising bond yields, including the US. Even the dollar won't be able to save Scott Bessent's bond market. While the Federal Reserve is moving to cut rates in just 2 weeks, US bonds are starting to revolt again. The 30-year is now about to breach 5% yield. And this is something we have warned about over the past few months. Just because you try to cut rates on the short end doesn't mean you can dodge reality. The markets will teach you a lesson because you're just borrowing too much money. Is there a fundamental difference between the US and UK bond markets? Yes. The US market, US economy is the single biggest in the world, and the dollar does give them a measure of protection. Alright guys, so our first wine and gold event is fully booked out, but we have a second event on the 24th of September that you don't want to miss. This is event number 2 on the 24th. It's going to be another night with wine and cheese. You get to learn more about the world of gold and hang out with me in person. Now talk with gold experts, chat about investing, and banter with me about absolutely anything on your mind. So come along for a night of fun, great bites, and truth bombs. And if you didn't RSVP for the previous event, it's time to sign up and discover more about gold investing and much more this round. We can accommodate up to only 30 plus people, so don't wait and RSVP soon. Details are in the link below. Join us at the event. And once again, it's September the 24th from 6 p.m. Get on board. I'll see you very soon in person and let's have a great time. And for those coming on the first event on the 17th, which is around 11 to 12 days from now, we'll be setting you the event schedule very soon, so stay tuned. But all that is a moot point when you consider the amount of money being borrowed. The amount of cash that needs to be raised is simply breathtaking. And if this was any other country, their bond market would be a smoldering ruin. Now, by the end of the year, a total of 6.4 trillion in US debt will be scheduled for refinancing. In other words, the bonds will mature and Besant will need to borrow new money to keep this shell game going. The problem lies with legacy debt that is borrowed at 10 to 30-year duration. Now that bond yields on the longer end are going up, your interest payments will continue to fly up, and the act of refinancing itself could push bond yields up even higher. And this is the doom loop Besant himself faces. It's a trap. And like the UK, there are only two escape hatches you can take. Now, one is to get the Fed to print the money, but as we all know, that is impossible without destroying what's left of the dollar. A QE at this point could push down bond yields, but I expect the dollar to fall by 20 or even 30% if this occurs. Now, the second option is simple but not easy. You have to cut government spending down dramatically, which means reducing everything from social welfare to the military. Now, government spending has to come down or there will be a serious crisis ahead. The spending spree simply has to stop. Now, this chart from Bank of America is very telling. Over the last 48 days, the US federal debt has increased by a crazy $1 trillion, and that's $31 billion per day, nearly $1 billion an hour. And let that spin in your brain for a bit. US government spending is nearing 50% of the entire country's GDP at World War II levels. So when someone tells you what really drives the US economy, frankly, it's government spending still. And this is how things are, and it's not going to get better until the tariff war ends. Now, there's an argument being floated around that tariff revenue will save the day. It's something that Scott Bessent has been peddling extra hard to justify the trade war, that somehow it will save the US financial economy.
And I think we're going to see a bigger jump from August to September. So I think we could be on our way well over half a trillion, maybe towards the $1 trillion number. This administration, your administration, has made a meaningful dent in the budget deficit.
So $500 billion of tariff revenue is coming, and it's bizarre how Besson really hails this as a victory because we kind of know who pays for it. Do some exporters slash prices? Sure, some may, but the majority of the pain is borne by US consumers themselves. We need to look through all the smoke and all the mirrors. August tariff revenue topped over $31 billion in the month. Yes, Mr. Besson, it is indeed a new record high. Now, he calls it fixing the financial shambles inherited from the Biden administration. But where's the money really coming from? This is a private sector bailout from US importers and US consumers. The money has to come somewhere, and it's all feeding into additional government spending. We are witnessing a pure destruction of capital. The world doesn't want to lend money to the US, so the only alternative is to squeeze the taxpayers in a roundabout way. And the consequences will be very dire. Yields on the 30-year government bonds are rising globally. The G7 economies are getting hammered. UK, Germany, US, and Japanese bonds, they are seeing yields just rocket higher and higher. And why are bond yields flying to the moon? It's a signal that inflation will continue to stay persistently high. Plus, there's a big fear that all these currencies will get devalued over the next 30 years. And that's why investors are demanding a high return. There's no smoke without fire. And everyone kind of knows how the tariff war will evolve. Countries will dig themselves into greater debt to subsidize their industries. It's really the only way to survive the trade war. But when you keep doing this, yields will climb and your currency will be under tremendous pressure. So the British bond collapse is actually a warning that US Treasury market is not immune. In fact, the cracks are already forming and people at the top, they're still really oblivious to the dangers. Now, despite the big warnings, US government actions will blow up the entire system. It's just a matter of time. Now, according to a Jackson Hole paper, there's this fantasy of the US debt to GDP hitting 250% without an implosion. But even the people writing this have given a big caveat. This is only possible with a fiscal adjustment of 10% of GDP or more. If not, there will be a sovereign debt meltdown. And here's how ridiculous the proposition is even today. That would mean cutting government spending by at least $2.7 trillion every single year. How is that even possible? Collecting revenues, collecting tariffs won't be enough, and the Trump administration can't stop spending. Will the US debt market get into trouble? Now, at this rate, the day of reckoning is fast coming. Might not be tomorrow, might not even be next year. But this can't continue without something major breaking. But let me know what you think. Can the UK recover from their bond collapse? And is the US Treasury market next in line? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.